Welcome to this Options Trading for Beginners series. Today's video is about cash secured puts explained for beginners. So personally, I'm a big fan of cash secured puts and I'll tell you why. So I'm going to give you an analogy and tell me what you would do in this situation. So let's say that you want to buy a brand new car and you find the car that you like and it's $40,000. What if I told you, if you give me 1 month, I can get you that same brand new car for $34,000. And if I cannot deliver on my promise to you, then I will give you $2,000 for your troubles. So would you take that offer? If you would, then keep watching because I'm going to teach you how to create this situation for yourself in the stock market. Now, let me explain to you how a cash secured put works. Let's say there's a stock at $10 a share and you think that it's a good buy at 10. But you can create a situation where you can buy that stock for 9. And if it turns out that you can't buy it for 9, then you will get paid some money. So essentially with a cash secured put, you can buy the stock at a discount. And if you can't, then you're gonna walk away with some money. Now, if you think that sounds too good to be true, it's not. I'm gonna show you the good and the bad with cash secured puts. So personally, I believe that the pros outweigh the cons, but I'm gonna show you both sides of the story and you can be the judge. Now, I'm gonna walk you through a real life example. And just so you know, I am not selling you anything. You can do cash secured puts on any platform or any brokerage account that you want. I'm just here to teach you so that you can become a better investor and make some more money. But before we begin, you need to know this. You must fully understand how put options work. If you don't, then please watch my other video about put options explained for beginners. If you don't, then you're gonna be confused in this video. So please watch that video and come back to this one. I will leave a link for you down below. In my previous video about put options, you were the buyer of the put option. In today's video, you're gonna be the seller of the put option. And the best way to explain a cash secured put is to just simply walk you through an example. And you're gonna see how amazing this is. So we're using a real life example. Let's use ticker symbol SIRI, which is Sirius, the satellite radio company. So Sirius is currently at $4.89 a share. And let's say that you think that it's a good buy at $4.89 a share. So you can buy the stock at $4.89 and just hope that it goes up. So that's one way to make money. But another option is that you can do a cash secured put. So here's what happens. Essentially, you sell a put option. By doing so, you lock yourself into an agreement as follows. Sirius is at $4.89 a share. Within 1 month, if Sirius falls to $4.50 or below, you will buy Sirius for $4.50. And it doesn't matter if Sirius goes to $4.50, $4.49, $4, or $3. If Sirius falls to $4.50 or below, you will buy Sirius for $4.50. But within 1 month, if Sirius does not fall to $4.50 or below, then you will not buy it. However, regardless of which scenario occurs, you will be paid 32 cents for agreeing to this. Therefore, regardless of whether you end up buying Sirius for $4.50 or not, you will be compensated 32 cents. Now, I'm gonna walk you through 3 scenarios and you'll see how this plays out for you. And you'll see the pros and cons of a cash secured put, and keep in mind that these are real numbers, so you're gonna see how much money that you can make. But first, let me show this to you so that you know that these examples are legit. These are real numbers. So we're using Sirius, SIRI, which is at $4.89 a share. Here's the options chain for Sirius, and we're gonna use the options that are expiring in less than 1 month. It's in 22 days, but we'll just call it 1 month to keep it simple. And here are the prices on those 1 month options contracts. So take a look at the $4.50 put option. Those are selling for 32 cents. So keep this in mind that we're using real numbers in our examples. Scenario number 1, Siri stock stays above $4.50. Now remember the deal. Siri's at $4.89. If Siri falls to $4.50 or below in 1 month, then you are obligated to buy Siri at $4.50. But if it doesn't go to $4.50 or below over the next month, then you will not buy SIRI. In this scenario, SIRI stays above 450. So SIRIs could go up. It could go up from the current price of $4.89 to $6. Or SIRI could do nothing from $4.89 and stay at $4.89. SIRI could go down a little bit from $4.89 to $4.51. Regardless, in any of these events, the price remains above $4.50. Therefore, in this scenario, you do not end up buying SIRI stock, but you still get paid 32 cents. So if you think about it, you did really well. Nothing happens, you didn't end up buying anything or doing anything, and you made 32 cents. But what was the risk here? The risk was that you could end up buying SIRI for $4.50. And what was the reward? 32 cents. So if you make 32 cents by risking $4.50, that is a return on investment of 7.1% in 1 month. That is an annualized rate of return of 85%. And remember, these are real numbers. Scenario number 2, SIRI stock falls to $4.50 or below. So let's say that after 1 month, Sirius falls to $4.40. In this situation, you are obligated to buy SIRI for $4.50. And because you buy SIRI for $4.50 and it's fallen to $4.40, you are down 10 cents. However, you have to remember that you were paid 32 cents to take on this deal. So in reality, you bought SIRI for $4.50, but if you factor in the 32 cents that you were paid, then you really bought SIRI for $4.18. And if the price of SIRI is at $4.40, then you're actually at a profit of 22 cents. But I want you to put this into perspective, because remember, when you saw SIRI at $4.89, you liked the stock and you thought that it was a good buy at $4.89. But by going with a cash secured put, you bought SIRI for $4.18. So you got a much better deal on the stock. You got in at a 15% discount. And remember, we're dealing with real numbers. So this is why a lot of investors love cash secured puts, because they pick a stock that they want to buy and they get to buy the stock at a discount. And if not, then they're going to walk away with some money. So it's a win-win situation. But I want to tell you the danger of a cash secured put. I want to show you the nightmare scenario. So here's scenario number 3, SIRI stock plummets. So SIRI's at $4.89. And remember the deal. If SIRI falls to $4.50 or below, you are forced to buy it at $4.50. In 1 month, if SIRI plummets to $1, you will be forced to buy SIRI for $4.50. So yes, you did get paid 32 cents for making this deal, so your true purchase price is $4.18, but still, the stock fell to $1. This means that you are down $3.18, which means that you're down 76%. So here's my recommendation. If you're thinking about doing a cash secured put, I would recommend doing it on a stock that you think is already a good buy. But you have to put things into perspective. So if you thought that SIRI was a good buy at $4.89 and you bought it at $4.89, if it falls to $1, then you would be down 79%. If you do the cash secured put, then you would be down 76%. So even though this is a nightmare scenario with a cash secured put, it's not like you would have been spared or done any better if you bought the stock outright. But I want you to still be aware of the danger. Now let me show you how to execute a cash secured put. So it doesn't matter which brokerage account that you're using, they'll all be similar. You go to trade options, and then you'll see an order screen that looks similar to this. In order to create a cash secured put, you will place a single order. And then you choose the ticker symbol of the associated stock. In our example, we're using Sirius, ticker symbol SIRI. We're going to be selling the put option, therefore we select sell to open. You choose how many put options that you want to sell. In our example, we're selling 1 contract. But remember, 1 contract is equivalent to 100 shares of stock. You'll select which put option you're selling. In our example, it's the put option expiring on August 18th. So this was the put option expiring 22 days out. You select the strike price. In our example, we used the $4.50 strike price. And of course, we are selling a put option, so we select put. I would recommend doing a limit order because if you do a market order, you could end up selling the put option for a bad price. And fill in how much you want to sell the put option for. In our example, 32 cents was the going rate, so I'm just going to use 32 cents. And remember, one put option equals 100 shares of stock. That's why you'll receive $32 for selling one put option, because if you sell one put option, you receive 32 cents per share. And 32 cents multiplied by 100 shares equals $32. And time in force, I filled in day. This means that if the order doesn't fill today, then it's gonna cancel itself automatically. You can switch this to good till canceled, but that's up to you. So I told you, it's very easy and straightforward to execute a cash secured put. In a separate video, we'll cover how to shop around for good deals on cash secured puts. So this is something that you'll get better at with experience. Now, I wanna end by telling you this. I'm a big fan of cash secured puts. I'm always on the hunt. I'm always looking for good deals. Please check out our website. If I find a good deal, I'll post it. I'll let you know about that. So thank you so much. Please subscribe. Check out our websites. I'll leave a link for you down below. And thank you so much.